Unfiltered opinion.
Sometimes you have ideas and you're not quite sure why.
As you secure the bag.
Sometimes you meet people and realize there's probably a reason why you stayed in touch.
Just listen.
Sometimes all the pieces just come together by themselves.
I'm Jimmy Moyaha.
And I'm Simon Brown.
Welcome to Insider Exchange.
Good morning. Welcome to another episode of Insider Exchange. This week, we're going to get straight into things because there is a lot to cover. We're going to be taking a look at our thoughts around the budget speech that is happening this week in South Africa. National Treasury will table that budget speech on Wednesday. We're going to share some insights around that. We're going to be taking a look at the inflation numbers and the unemployment numbers that are set to come out from South Africa, our expectations around those, and we're going to see if we can have a poll around the next executive order to come out of the United States. So stay tuned, stick around with us. If you are joining us on a live stream and you are in the chats, welcome. Thanks for taking the time to listen to the stream. If you're going to listen to the stream and catch up on it later, remember there is the deep dive and the investor insights that are still to come as well. This week's deep dive looks into financial advisors and whether or not you need them. So perhaps dip into that as well. But if you're on the live stream now, thanks for tuning in. Shout out to our TikTok community. Thanks for coming along for the ride as well. We've crossed that 20,000 threshold. We're now on our way to 40,000. We're moving. We're going to keep moving. That's our next target. That's our next goal. But yes, we couldn't have done any of this without you guys. We couldn't be doing all this without the support from our communities. So thanks to our communities. And most importantly, welcome back, Sai.
Yeah.
The man flu didn't get you.
It tried, but I found the best thing. I just went to bed for a day.
Oh, really?
Slept. Yeah, like phoned you. Like I did the show, messaged you, said, nope, not coming.
Uh-huh.
Woke up, had lunch. Woke up, had dinner. Done.
Really?
Yeah. Sleep.
Sleep.
Huh. Well, and Medlemon and Carosa C and a whole bunch of, I don't know.
Whole bunch of things.
Stuff my wife was feeding me.
Yeah.
Sleep.
In wives we trust. In wives we trust. They know what's best. I somehow think this is what's passed down from generation to generation. Because as you grow up, it's your mother that does this typically, right? Mm-hmm. And then somewhere along the line, wives inherit this thing from the mothers on how to fix the husbands and how to fix the fathers. And so then the wife then becomes the mother themselves and so on and so
they
forth.
Fix it.
And you never really know when the transition happens, right? It's kind of like those red sweets that Granny always has. We all know the ones I'm talking about, the strawberry flavored red sweets that are wrapped in the red wrapper with the green thing on the top. Nobody knows what they're called. Nobody knows where to find them, but every granny has them, right? That's exactly what it's like. Speaking of things everybody has, budget speech. Every country has them, and we have ours this week on Wednesday.
It's going to be tough.
There's a lot to think about. There's a lot that's going to go into it. I mean, I'm thinking about the expectations, obviously things around VAT and sin taxes and all of that, the normal things, right? But what concerns me is the abnormal that's starting to come out. There's a loan. There's a loan, everybody. There's a loan.
Yeah.
There's a loan that we've applied for with the World Bank. We're still having our credit score reviewed. We haven't been pre-approved.
We're sending FICA docs.
Yes, we're sending the country's FICA docs to the World Bank. What's the size on that loan again?
Is it 24 billion?
24 billion
24,
rand. Let me get the amount. I saw it. And apparently the rationale behind this is because this is kind of, 27 billion rand. 1.5 billion US dollars is what we are negotiating. We say negotiating, but reality is we're applying to the World Bank to give us a $1.5 billion or 27 billion rand loan.
That's small change, isn't it?
For who?
For our finance minister.
Well, South Africa used to pride itself on being one of the countries that has the best kind of loan structuring in terms of rand-denominated debts. And so therefore, but now you're going to the World Bank and you're increasing your foreign loans. Now, what are the terms exactly? What are the terms that's going to come under? And what is the money going to be used for? Like we're saying infrastructure.
Frankly, to balance it, right? Because, so by reports, if you look back at October, there was a shortfall in revenue. Mm-hmm. We expect a lot to have changed since then. So probably still a shortfall of, I think it was 20 billion back in October. So some sort of shortfall it wasn't a shortfall. We always make a shortfall. Mm-hmm. Revenue was running lower than expected. Mm-hmm. So we've got that hold. The president maybe alluded to a basic income grant in his SONA which we're kind of doing, which is still the hangover from the pandemic. SDR, SRD.
Social Relief from Distress Grant, SRD.
SRD. So kind of like maybe formalizing that perhaps. Talk around increasing the number of things that are VAT exempt and not books and stuff, but like cabbages or vegetables.
So South Africa is basically taking money to plug other holes, and as citizens we can't do that, but as the government it's fine for them to do that. So the government acknowledges that revenue's falling short, but when we tell the banks that revenue's falling short and we need some credit, we don't get credit.
No, they just tell us to go get another job or send your kid to work or something.
Can we tell that to the government? Can we tell them to get more income from somewhere? I'm sure we can. Whether or not they'll listen is another story.
I mean, it's going to be a tough budget. I mean, remember Eskom wanted 36% and got 12. They got 100 billion owed to them from the municipalities. I mean, is Eskom out of the woods? Transnet.
And there's going to be a lot of conversations around those SOEs, right? The bailouts. Post office wants almost 4 billion. So let's say we get the 27 billion rand, right? 4 billion already to the post office. Come on.
So you can get a letter.
No. Send me an email. Send me a postcard, which might actually, no, that's the post office as well.
You won't get your postcard.
But who still uses postcards?
Oh, postcards. I go to the post office once a year. There's one in Greenside, and I renew my car license.
Yes, but that's all we really use the post office for. But you can now do that at Spa.
But here's the thing. Hey? Print your document before you go there.
Yes.
Make your own copy of your ID book and take your own pen.
Yes.
The only thing they actually can do is like zip the credit card, and then they can print out the actual little disc.
So we're effectively just using them for a speed point and a printer, which we can purchase ourselves from Yoko. And
yeah, but you got to hook it up to the government. So I don't know. That's the only thing. I mean,
I remember a conversation with the former CEO of the post office. We're getting a little sidetracked from the budget. Mark Barnes. And he said the post office shouldn't have gone into this crisis because it was just poorly managed. That's a story for another day. We're not going to get distracted. We're going to stay on topic. We're going to stay on task. And on task is the budget speech this week. We know how difficult it's going to be. We know the tight balancing act. Are we expecting to see any tax relief?
No.
Okay.
No. So I mean, individual corporates. So remember we're on that glide path, or I think we've glided, where we were looking to bring our corporate tax rate down. There's been talk that we're going to jack it higher, but we're not. That's not going to happen. So corporate tax has been coming down a little bit over a few years, and I think we're at that target. For individual taxpayers, if anything, we're going to see bracket creep. In other words, they just simply don't increase the brackets by the inflation rate. So it just gets a little more painful. I mean, is VAT coming down? Not a chance. If anything, maybe VAT's up, because you're in that rare window when your next election is like late next year. So you're far away from an election. So if you want to do something that people won't like, it's now.
So you're saying because you've got another budget speech between now and the next election to rectify it.
To make people forget. Or hope that they forget. Yeah, but I don't think VAT goes up.
Yeah, but does it? That was my question. Does it make sense to then hike the VAT? Is that a good thing at this point? Because surely, if you're planning on increasing the amount of VAT exempt items, that's supposedly going to give relief to those that could historically not afford that, or those that are struggling to afford those items. Great, fine, lovely. But the purposes of increasing the VAT, the last time we did it by 1% from 14 to 15%. And have we really seen a tangible benefit where we can say, okay, let's go from 15 to 16%?
Well, it's an easy way to get extra money, right? I mean, I can't remember what VAT is, but if VAT is 30% of revenue, if you push it up by 1% from 15 to 16, your 30% goes up to 32. I mean, it does just, it's an easy flow through in terms of cash. It's fairly tight in terms of its you can do fraud, but there's not a lot of VAT fraud happening and 15% by most markets is a low VAT number. I mean, the UK, I think it's 20, and I mean, there are markets out there where it's in the mid-20s. So
do you know what else is an easy way to increase the amount of revenue that the government makes? Create jobs.
Well, yes.
Have lower unemployment.
Yes.
That would certainly fix the problem. I mean, you touch on the UK and you mention the VAT rate in the UK, 20%. Okay, happy days, great. What's the UK's unemployment rate? 4.4.
There we go.
What is our unemployment rate?
32.
Depending on which metric you're measuring
Well, that's
it
the
by.
official
We've
one, for sure.
found ways to window dress the fact that we might be at 40% unemployment.
Yeah. So the 32% is that if you aren't looking for work, you're not considered unemployed. Which, I mean, that's the standard rate. That's, when we say the US's unemployment is 4.1 or the UK is 4.4, that is all saying that if you're not looking for work, you're not considered unemployed. Our expanded unemployment rate is around 40 something.
Right. So the youth unemployment, according to the Stats SA May data from last year, was at 45.5%, with, as you said, overall unemployment 32.9, so call it 33%. 33%, 4%. They can afford to have that at a higher rate, right? And even then, they have employed, which again comes to the data that's coming out this week as well. Unemployment data is coming out this week from our side. We've also got CPI data coming out from this week. Do you think that any of these latest data points are going to be factored into Wednesday's speech?
No, I think not, because unemployment is a horror show, and what's it going to do? It's going to move a little bit one way or the other. We might actually pick up a little bit, but it's not going to get markedly here. It's not going to where it needs to be, which is, single digits at the very best. Inflation was 3%. It's probably going to drift a little higher because of fuel prices, and a lot of annual increases come through in January. So inflation may be a little bit high, although they've apparently retweaked the basket again. But I don't think either of those are massively going to stress the minister. I think what's stressing him is lack of money. And then, does he do a wealth tax? Something like that, perhaps. We remember our top tax rate used to be 41 or 40. And then
45 at the moment.
It got bounced to 45.
Yeah.
Does he try something like that? But that's got to be very targeted. In other words, we're going to do this wealth tax and the money is going to go here rather than just into fiscus. We did one in 94 where we had a wealth tax which was going to go into the RDR. Was it the RDR?
Yeah, but so this is the thing. I don't know if we're capable of doing targeted because look at the central bank seizures as well, right? The seizures from the breach of exchange control regulations that have been taking place and all of that. That just gets thrown into the same revenue pool that the tax collections get thrown into as well. It's just, let's just collect all the money, put it all together, and then decide where it has to go. Now, for everything it's worth around our Minister of Finance, he's always been quite conservative as a Minister of Finance. He's tried to take a modest and prudent approach, but obviously understanding that he's had a tight balancing rope to balance in the past. How much more of a balancing act does it become now under the fact that this is the first budget speech under the Government of National Unity?
That's a good point. So there is a GNU. And again, so the way the budget works is you get input from ministers. What do they need for their various different departments? And then you go and collate and you say to the ministers, yay or nay. Do they throw some non-ANC ministers under the bus? Careful about throwing agriculture under the bus. Home Affairs is looking decent. Don't throw that under the bus. What else we got? Gayton McKenzie. Sports, prisons, the Groenewald man.
Yes, Dr. Groenewald.
So, probably not. I suspect that our finance minister and his team is probably, in that regard, not going to say you're the wrong political party, so we throw you under the bus. But there's going to be some hard questions, and then it comes back to we spend a lot of money in education, huge amount of money in education, like 10x per kid what Mozambique does. They get better outcomes than we do. It's not just the budget, it's the utilization of said budget that is often the real stumbling block. And that's outside of state capture and graft and corruption.
Yeah, but that utilization as well comes through in the allocations to state-owned entities, right? So at the end of the day, the party allocating the budgets remains the ANC, whether or not we're under GNU or not, right?
Yeah.
So the key decision that needs to be made from a budgetary allocation perspective is very much, as you're saying, a position where the ANC can choose to either gain favor with its GNU partners or put them out in the cold, risk losing even more traction in the 2026 elections or whatever the implications of that are. But at the end of the day, it's the same kind of thinking that has been allocating budgets for the last 5, 6, 7, 8,
Correct.
9, 10 budgets. So it doesn't really mean that we're going to see anything different here. Understanding, of course, that maybe there might be a different drive towards wanting to drive. There's always been a conversation about increasing economic inclusion and all of those sorts of things. But the reality is very little of that has actually happened and actually translated into the economy.
It's like the big talk around infrastructure every budget.
Yes.
Now, back in 2008 under Trevor Manuel and Mbeki, infrastructure was being spent. Although, we got Gautrains, we got stadiums, we got all sorts
No.
of
We got
things,
that because we won the World Cup bid. We
yeah.
didn't get that because it was going to happen.
But no, the Gautrain predated it. The Gautrain was independent of it. But stuff was happening. Hospitals were being built and schools and stuff and roads. And that's kind of all just kind of faded away.
So you say the Gautrain predates it, right? But the acceleration around the Gautrain was because look at what's happened since. We had a 10-year plan that after 10 years after the World Cup, we'd have the Gautrain that runs into Cosmos City, that runs into Roodepoort, that runs into Fourways, that runs into other areas of the country. It's still the same line and it's 15 years later.
And the Rosebank Park station is closed.
Oh yeah, because somebody decided to drill their borehole and not get the correct authorizations, whether or not, well, I don't know. So on that, whose fault is that? Because if I don't know that the Gautrain is running beneath my home, am I at fault here? Should I have been informed of this? Because when it was constructed, it was put in place and all of that sort of stuff. Those homes would have been there or might not have been there anyway. But I wasn't informed where the line would run. I can't see a topographical map of where this tunnel runs.
Yeah, so surely the borehole driller. I mean, so
maybe.
First question, am I just allowed to do boreholes? I thought I would need permission for a borehole. But
so you call a specialist apparently, and I think the specialist then does stuff things. Mm-hmm. So maybe you phone the wrong specialist.
Mm-hmm. Awkward.
Awkward.
It's not Gautrain.
So who foots the bill in this case? Who covers the expenses?
Yeah.
Because if you could just afford the borehole, now you're...
And that Rosebank Park has been, remember there was the sinkhole? Mm-hmm. So it was, and then there was water ingress. It almost bankrupted Marion Roberts, and then they just did it themselves. I mean, it's been,
There's a lot happening. There's a lot happening.
Yeah.
So yes, get a specialist the next time you're looking at your borehole. But yeah, there's a lot of stuff that's coming up this week, and this is just the things that we have picked up on. And we were chatting about this before we went live to say the one thing we haven't been able to pick up on in the last 3, maybe 4 weeks is executive orders, because they come up as you are sleeping, and before you know it, there's an executive order for anything and everything. So that's going to be the next thing, right? Is executive orders. Let's put it out to the community. Let's do that. I think we should do that. We want to know. Sai and I are putting this out to our community as we wrap up Market Matters because we've run out of time. Let us know in the communities what you think will be the next executive order and how it'll affect you, because clearly they're going to affect us all at some point or another. And when we look at all of the things happening in the United States, the executive orders are one. The other one is, and perhaps I'll leave it on this note, right, for Market Matters. I wanted to use it as our unfiltered opinion of the week. But maybe we can have more than one unfiltered opinion of the week. Who's going to stop us? The whole show is about unfiltered opinions, and we make the rules. So my unfiltered thought around what's happening is you can take the African out of Africa, but you can never take Africa out of the African. And why I say that is because this seems like a lot of effort that Elon Musk went through to get a Tesla tender. We're going to leave it on that note. That's Market Matters for this week. Stay tuned for Deep Dive. Stay tuned for Investor Insights. Those will be dropping later this week. But for now, that's where we're leaving Market Matters. And we move on to our deep dive. This week, we are taking a look at financial advisory. Do you need a financial advisor? Is there still any merit to having a financial advisor? And what do they still offer? If you've missed any of the conversations that we had in our Market Matters, we touched on what our expectations are for the budget speech that's coming out this week, Wednesday. So catch up on that. It's under the live section on our YouTube. But if you're listening to this via the audio podcast, you would have just listened to this as well. We are going to bring in someone very opinionated for this particular deep dive. Now, again, this is something that Sai and I have always been able to leverage off of in our time in the media world and in building this podcast is the rich network of friends that we have that have very strong opinions about things and opinions that we like to share. So we're going to be introducing someone new that you guys might not have seen on the show before, that you might not know of, but we can assure you he is very, very intelligent. He knows exactly what he's talking about because he's a wealth manager and director at PSG. Which PSG is it?
That's R21.
R21. There we go. There's quite a few PSGs, right? So there's PSG Old Oak, PSG Wealth. This is PSG R21, all part of the same family. Neelis Brink joins us in studio. He's going to be taking us through his thoughts around financial advisory. Neelis, thanks so much for joining us. Thanks for coming through. It's absolutely lovely to have you on the show. And I think this is probably going to be one of those conversations where everybody thinks it goes one way and then it's going to go a very, very different way.
Take a sharp left turn.
There we go, right? But that's why we have it. That's why we have these unfiltered opinions. I know Sai's been his own financial advisor for his entire life. And that comes from a lot of learning, I suppose.
I had one in the very early 90s.
And then?
Yeah.
There we go. So we're going to be looking at financial advisory. We're going to be looking at the role of financial advisory and if there is a place for it. Sai, let's start with that, actually. Why did you let go of your financial advisor?
It's the story of everyone's, right? I was 24 or something and my mother said, you need a retirement annuity. And I'm like, hell yeah. Yeah, I'm a responsible 24-year-old. I will get myself a retirement annuity. So I hooked up with her advisor who worked for one of the big long-term insurers. And he sold me two things, a retirement annuity that made me approximately zero money over its life. It's one of those old school ones. Remember the ones we discovered your fees were like 60% and a lot of people made money, but it was not you.
That's it.
I had one of those. He also sold me a unit trust with a 5.4% total expense ratio, excluding performance fees. It never performed. So I never paid the performance fee. And I eventually got rid of the retirement annuity and the unit trust. Unfortunately, I didn't get rid of the retirement annuity quick enough. We didn't know. It was Rob Bisconi in the early 2000s who alerted us to the problem. And even, it was probably 2008, 2010 when there was some proper fee available. But, and with respect to the oak who was selling it, who I don't have a lot of respect for, this was the industry. He wasn't being special. He didn't single me out. But what really aggrieved me that as a 24-year-old, here I am making a good financial responsible decision and I just get carted under the bus.
How many years ago was that, Si?
It was 94.
1994. So in 1994, that was the condition of the space. Neelis, is there still a place for financial advisory today? Or does it look very much similar to what happened there?
I absolutely love Simon's case study because this is almost what's wrong with the industry, right? So you've never dealt with a financial advisor before.
No, not in because, and let's be clear, there was no needs analysis or any of that sort of thing.
There wasn't regulation at that point.
Yeah, this was just like, you need something, how much can you afford? I think this much, can you make it more? Sure, bang, done.
So I want to unpack this a bit. And it's not to shame anybody. I think we should very clearly understand the different roles available out there. The individual that Simon dealt with, and they still exist today,
Sure.
is called a broker.
Okay.
A middleman that sells a product.
Okay.
Right? So he does exactly what is required of him. You found him and said, I would like to buy a retirement annuity. And this individual took one off the shelf and sold it to you.
Yeah.
He did exactly what you asked.
Yeah.
But now we must remember, Simon at that stage, that was before you got really, really rich, right?
I was living in Pietermaritzburg, man. There was no money in my life.
So at that stage, Simon could afford probably the minimum premium, $250, $300 a month.
Yeah.
Right? So you are not going to get a private wealth manager managing hundreds of millions of rands to take care of a 300 rand price point. So where do we go from here? The long-term insurers built a system to reward someone to take care of Simon, right?
Yeah.
With upfront commission.
The broker.
Or a life-wrapped product. Exactly. So the broker. The broker sells it, and at that stage, that's way before we regulated commissions or regulated advice.
Yeah.
He would have probably made around about 3,000 to 5,000 rand in commissions from that 300 rand policy.
Okay.
The policy was extremely restrictive. So if someone wanted to decrease the premium, penalty would be charged immediately. If someone wanted to cancel the policy at some point before he turns 78, penalty.
Yeah, paid the penalty.
And investment decisions was something like, do you like high risk or low risk?
Yeah,
that's the two options. Tick the box.
100% right. That was it. High risk or low risk. And I'm like, yeah, I'm 24, high risk. And then annual escalation, which couldn't be CPI. It had to be a number.
Yeah, it had to be a number.
And the number was like 10% or something. And I once ran the numbers. Like by the time I turned 78, man, I was paying 4 times my annual salary in a monthly.
That's
because
it.
10% a year for 50 years
Is a lot of
quickly
money.
gets big.
Yeah.
But now at that stage, he would ask you, but do you not want to escalate by 10%? So you want to be poor. You don't want to retire. So that created a whole industry of salesmen. These are not financial advisors. These are not wealth managers.
They're selling
salesmen.
a product.
Their job is to sell as many as possible.
Yeah.
They still exist today, and they cater for a very specific market. I think there is a very good place for a broker in today's structure. I think there's a place for a wealth manager. But we must understand these are two very different people.
Before we get into... Actually, let's get into the wealth manager. I want to add a third category, but let's get into the wealth manager. What then does the wealth manager do that's distinctly different from the broker?
So there has been a lot of regulation that rolled through, but I think this should have been part since day one. So I don't want to dive too deep into regulation. I think I want to dive into what should be done from a wealth management point of view. What does a wealth manager sell? Because I saw on the debate on MoneyWeb's comments, that's where you want to be, right?
Okay.
If you're bored,
The comment
delve into
section.
MoneyWeb comment section. And I saw a debate in there where an individual said, you should be looking at what the advisor, broker, or call it whatever you want, what they drive and what do you drive. And that's a fundamental problem.
Niels, what do you drive?
That's a good question.
We'll come back to that.
So, what is the better car, right? The Porsche GT3 RS, or should you be driving a responsible 3 Series BMW?
Who am I? Am I the client or am I the broker?
So from the broker's point of view, or the advisor, whatever you want to call it, they are not there to make you rich.
They're incentivized to sell you one product and be done with you. There's no...
On a wealth manager specifically.
Okay.
A wealth manager is not there to make you rich.
Okay.
Strange way to think about this.
Wealth manager.
They're managing.
They're managing wealth. They're
wealth
not there to
manager-
create. They're not a
they
wealth
don't create.
creator.
And that's a small part of what we do.
Okay.
Our main fight is to preserve the money you have against inflation.
Okay.
Right? And then the track structuring thereof, what happens upon death, what happens upon disability, to manage the wealth you have. If you do not have money, we cannot create money.
It becomes difficult to get a wealth manager to manage wealth that isn't there.
Exactly. And a good wealth manager might beat inflation by 2% rather than 3 or rather than 1 or breaking even. But a wealth manager's primary job is to keep the money you've already made. So a wealth manager, to use the car analogy from the MoneyWeb comments, should never put you in a position to buy a Porsche. You should be buying a Porsche from your income derivative,
Okay.
right? The wealth manager bought his or her Porsche from their income derivative, not from their own investments. So people tend to come into our practice expecting us to generate money for them. And we should be protecting money against the taxman, against inflation, against bad emotional decisions. So that's what a wealth manager does. A broker simply sells a product,
Okay.
and there's a place for them. Think about a stockbroker. You phone them and ask them to buy you 1,000 shares of Capitec. It's that simple. They must simply execute. Take it off the shelf. Yes, there's some regulation. They should get it at the best price possible. They should not overcharge you. There's some regulation around it. But they move product from A to B. Then you move to a wealth manager. They fight against inflation. And you said you wanted to add a third category.
I want to look at the role of artificial intelligence in all of this, because as we've come into a more modern world where access to information has become easier, it's much easier than Simon in 1994, because now at the touch of, or at a conversation with ChatGPT or Grok or whatever it is, I can ask the questions that I should have been able to ask in 1994 that I might not have been able to get the answers from. But ChatGPT can now consolidate all of that information and say, these are the best strategies, this is how they've outperformed, this is the data, this is all of that. Does that not then replace some of the work that's done in financial advisory and now give you a better edge, because the AI has no incentive to lie?
Of course. That's a brilliant question. We discussed it at length in our partner meeting a couple of weeks ago. So AI strengthens our hand as an advisory firm, because we have got the ability to do research much quicker than we used to. I'm not of the opinion that AI can replace a wealth manager, for the simple reason there's two things that AI can't do yet.
Yet.
I can't tell you which questions to ask.
Yes.
So you need almost a wealth manager background to ask the right questions for the AI to provide the information. And then secondly, AI cannot manage your emotions. I spend much more time managing my clients' emotions rather than managing the money. Managing the money is the easy part, right?
The money doesn't talk back.
You put 70% of your money in growth assets, 30% in cash and bonds. Make sure you have sufficient offshore exposure to protect yourself against a weakening rand.
Come back in time.
And stop carrying on it. Right? It's that simple. The difficult part is your client contributing enough? Your client loves moving money around, right? Because they just heard about this new shiny thing that they want to pursue. It's very difficult for a client to stay in their position if the market takes a dive.
Yes.
Think about COVID.
Yes.
Right? COVID unwound the market in 2 weeks' time. 36% down locally.
Yeah.
For your client to sit still there is extremely difficult. So much so that you'll see most successful wealth managers don't manage their own money.
Because it's their own emotion that they need to entrust to
Money
someone
is
else.
emotional.
Yes. But that goes for a lot of anything to do with money. I mean, I think about, so I come from the trading background as well, and you look at CFDs, and when you're in a position and Donald Trump says something and the market moves, or data comes out and something, it's the emotion and the psychology and everything that comes with it. So wealth management is no different. It's just under different parameters, I suppose, that you're managing the decisions. So how then do you cut through the noise? How then do you identify the good from the bad in terms of financial advisory? And are there specific red flags where whatever we call this advisor, whether it's a bot, whether it's a wealth manager, whether it's a broker, how do you then say that is something to stay away from? What are those red flags to look out for?
So why should you use an advisor? Why should Simon have an advisor? It's that simple, right?
Yeah, Simon, especially someone like Simon,
The layers
who does all
that
of
you
his
should
work
be
himself.
going through. Very first thing is I think we should be looking at qualifications.
Yes.
It's not everything. Definitely not. I know very successful wealth advisors that barely has matric. And I know advisors that's got every degree available in finance, and they still make a lot of mistakes. Right.
Okay.
But some form of qualification helps you sift through the masses. Because remember, I don't know if your listeners know this, but you can get a code to start selling financial products. I think if you have grade 10,
Okay.
right? You can apply for a code and start selling it the next day under someone's supervision. That's
Yes.
true.
Yes.
But you can start selling it the next day.
Okay.
You don't have to have matric. You don't have to have a BCom. You don't have to have a CFP.
But I suppose this is where things like continuous professional development start to then kick in to say you might have started at zero, but you need to uplift and upskill yourself so that you don't stay at zero.
But then continuous professional development as well. I mean, how well is that really monitored?
Yeah.
Fair enough.
18
It's
points a
18
year of
points that you can
watching-
get from watching videos.
Exactly.
Which we can do with a platform such as this and create that kind of content as well. It's as you said, it's about finding the right content and the right information to be able to add. Okay, cool. So education or some base level understanding of what financial products are and what it is you are selling.
And then two more things.
Okay.
A track record.
Okay.
That advisor must be able to show you a track record. Not what would you have done. That's easy. What have you done?
What have you done?
Show me your performance through COVID. Show me your performance through 2017, through 2008. What strategies did you guys employ when you didn't know what's going to happen next? Right? And then thirdly, and I think this is the way to keep yourself safe, is you must deal with a firm that's got different layers of protection. The amount of layers that advice goes through at PSG before it reaches the client is what keeps you safe.
What do you mean by layers? Take us through some of those layers.
So firstly, we have to develop an advice plan. So anybody, and if I say anybody, I mean my most junior advisor that's been there for a week, can meet with you and gain information because they've got a very specific list of questions that they need to ask you. They then bring that information back to an advisory board. They don't go sit and thumbsuck it themselves. They bring it back to an advisory board because there is a correct way of doing it. That's what I love about the numbers. There's a right and a wrong answer. It's that simple, right? The advisory board would then put together the advice pack. That advice pack goes through compliance and legal. And then that pack comes back to the client, and my 1 week experienced financial advisor explains it to you.
Okay.
Right? So he or she seems brilliant. They can make no mistakes, essentially, because it's been reviewed by their seniors. And you get to deal with a junior, a senior. They won't make mistakes. And then it goes back to the implementation board. And they put the advice in place. That's the only way you're going to safeguard yourself against fees. Fees is a big issue, and we'll deep dive into that a little bit deeper in a sec. But advisors simply making mistakes. I've had senior advisors simply slip up on a tax issue or slip up on an asset allocation somewhere. And that's what these boards are for, layers. It's not going to help if you deal with a single person. What if they get sick? What if they get tired? What if they just simply don't go to work today? Right. So that's extremely important when you're dealing with a firm.
Okay, so now the foundations or the things you should be looking out for there, right? But what about the costs? Because as I experienced, these things aren't cheap. And I can imagine what comes to mind is when you have a firm that has those layers in place, those layers are an overhead for you as a business. You guys you're a business. You need to make your money. So how then do we balance Sai's need for affordable financial advice, because he doesn't have all of the money in the world to spend on advisory services because he's still trying to make money.
Sure.
And how do you manage that against getting good, decent advice?
So firstly, obviously, you get what you pay for. This world of cheap advice does not make any sense. At all.
Okay.
If you go to the doctor and the doctor says, I need to refer you to a specialist, you need to go to a cardiac specialist. Your first question shouldn't be, who's the cheapest in town? Right?
It's who's the best cardiac specialist?
Who's the best?
Okay.
And then we'll go from there. Same with when you want to hire a lawyer and he says you need an advocate to present you in court or represent you in court, rather. Who's the cheapest in town? Not a question you'd ask. Why do you want the cheapest financial advice in town?
That's
so let's
a good
get
point.
started there, right? That being said, someone wants value for money. And this is extremely simple in my mind. You just want what it says on the box. It's that simple. Right? A Ferrari selling at 10 million rand. That's not expensive. 10 million rand's a hell of a lot of money. But for a Ferrari, it's not expensive.
Okay.
But you're not going to be very happy if you drive out of there and the fastest you can go is 60 k's an hour because they didn't put an engine in it.
That's not the Ferrari I bought.
You want what it does on the box.
Okay.
Why are people, especially people from that had these horrible advisory experiences in the early 90s and even today, it's because they bought something that didn't grow. Yeah. Because of fees, because of mismanagement, because of misallocation.
But I also think a part of that was because of the knowledge that was out there. So you mentioned those that bought financial products in the 90s that didn't grow. I look at it and say the generation that followed that and the generations that are following on are making different decisions because of that. I'll use a personal case study. My mother's been in education for over 30 years, which means her pensions and funds and all of that are managed by the PIC. Now, some of the decisions the PIC have made over the last couple of years, even without at a base level, there's certain decisions where that's it, where you say, you guys put 4.5 billion rand into who? To do what of my mother's pension? So obviously that then informs how I approach financial advisory and financial conversations thereafter, because I've seen what happened in the past. I've seen it not work out. I've seen retirement annuities and funds and big companies, listed companies that have not performed. And so when we take financial advisory into 2025, I say I'd much rather get my information from an AI because that clearly is not going to be working against me, whereas I've seen financial advisory in the past has worked against my parents. How do you then not carry those trauma decisions of the past? I mean, Sai, how did you do it? How did you, aside from the fact that you had the unique advantage of getting into finance and putting yourself into finance, for those out there whose parents may have had a fund sitting somewhere, now you're having to make that decision for yourself and for your kids. You're in that space where you're saying, I now need to look at that future. How do you take ownership of it without making the mistakes that Sai made in 94?
I mean, not easy. I mean, my mother also had a policy from this chap, and when she passed in 97, there was practically nothing to it. I mean, it was, and for me, I mean, it scarred me, right? I saw this thing doing terrible, and instead of sort of digging around more and saying, well, what's the problem? It was like, well, this stuff is terrible, and I just walked away from it. And probably if I'd been more proactive sooner, there would have been a better outcome from it. But it comes to your point as well, which is that distinction between broker versus advisor. This chap, I phoned him. I said, I need a retirement annuity, and he's like, well, cool, we have one. Ask me the few questions that were relevant, and
take one off the shelf and let's go.
Yeah.
Do you own a retirement annuity today?
I do.
That's exactly my point.
Okay.
So a lot of people, because of this trauma decision, has come to a point where they say a retirement annuity is a bad thing because it doesn't grow. A retirement annuity is a tax structure. It's not a thing. It's a tax structure, right? To my mind, retirement annuity is one of the best tax structures that we see in the market.
Okay.
If it does what it says on the box.
If it does what it says on the box. Tax structure. So tax structures are going to be an interesting conversation because I happen to know this because you and I have spoken about this, Neelis, and we'll get into this in another deep dive, is that retirement annuities are not your favorite tax structure. And even though you say it's a good structure, it's not your preferred one. But we are going to leave the conversation on that note. And I want to leave it on that note because I want to leave room for the follow-up conversations. But there are basics around financial advisory. There are things you can do to avoid putting in place or to avoid engaging with a financial advisor that you shouldn't. And I want a parting thought because this is something that I know we're going to get a good piece of intel out of, right? Our unfiltered opinion of the week that we typically do at the end of our show, we're going to put it through. We've gotten one for our Market Matters. We're going to do a 2-for-1 special this week because Neelis is in studio. We're going to get an unfiltered opinion from him, and that's going to be our unfiltered opinion of the week. Neelis, the unfiltered opinion is something you believe might not be popular to hear, might be an uncomfortable thing that people might not want to hear. And I know you're not afraid of having uncomfortable conversations. So I'm going to put it to you and ask you what your unfiltered opinion is of the week.
I don't think you should be dealing with a financial advisor that can't show you a track record.
Okay.
But I also want to add to that, I don't think you should be going to a wealth advisory firm before you can afford to.
Ooh.
There you have it, folks. Wealth advisory is not for everybody, and financial advisory isn't for everybody either. That's the deep dive. That's where we're going to leave the conversation. We're going to thank Neelis. Thanks so much for joining us in studio. Neelis Brink, Wealth Manager and Director at PSG Route 21, joining us to dive into financial advisory and everything that comes with it. And we wrap this week up with Investor Insights. We're taking a look at Asian markets. They seem to be coming back into favor with the investment community, but we're also going to update our wall and see if we're going to add some things, take some things off, move some things around. Asian markets recently have been quite the flavor of the month, right?
Last 2 weeks.
Yeah.
So they were closed for Chinese New Year. Well, not all of them, but much of it.
Yeah.
And then there was the deal because China, Apple can't use its American ChatGPTs in China, so they struck a deal with Alibaba. So Alibaba's gone absolutely crazy. But if you remember back to September last year when we got the stimulus and there was this giant rush in
that
China,
collapsed.
Hong Kong, that collapsed. Well, we're back at those rush levels, which also happens to be back at January 23 levels, which also happens to be March 22. So markets are suddenly looking interesting. Don't zoom out too far, man, because you're going to see...
Don't look further back than that.
Yeah.
Just the last 2 years.
Yeah.
So the China story, how much of the China story, or not even the China story, the Asia story, but we say China because that is the bulk of where the attraction is Hong Kong, mainland China, maybe a bit of the Nikkei in Tokyo, but Tokyo kind of deviates from all the other movements around the world. But how much of that is markets looking for returns because China and Asian markets and even developing markets have been undervalued? And how much of that is a hedge against what Trump is doing? So Trump puts out a tariff. China's not afraid to respond with their own tariffs. And China's proven historically every single year, including the last year, that if they're going to put money into their own local ecosystem and their own local economy, they still hit 5%. They still hit 5% growth every single time.
So some of it is about valuations, where these stocks are trading in sort of mid-teen valuations, tech stocks, JD.com, Alibaba's, Tencent, et cetera. So they're trading at really attractive valuations, particularly relative to the US tech valuations, which are massively stretched. I think we've also finally moved on from the common prosperity and all that crackdown from Xi Jinping.
Okay.
And truthfully, when he came in for his third term in October 23, so now a year and a half ago almost, he pretty much said, we've done what we wanted to do. But I think the market was perhaps a little disbelieving. And on the flip side, you had Meta and Nvidia and the others all going to the moon. So why not? You didn't have to be believing you could be making your money there. And then tensions, because so the whole tariffs and everything like that. The weird thing is, well, surely you rush into the US where it's safest and you go get 10 years at 4.7 or something. But the dollar index has been weak the last little bit, and Rand's picking up, dollar index has come down last few weeks. Suddenly it's like, okay, hang on a second. And it might just come to, in the volatile, uncertain Trump world that stares ahead of us for the next 3 years, 8 months, and however long, 10 months, whatever it is. If Trump does half of what he says he's going to do, what's the impact on the US economy? And the answer is probably not good. The question is, does he do half? And truthfully, no one knows. So maybe the world is looking for other places, except that we haven't seen Europe running, but before I make such bold and brave statements.
Europe's been going through quite a bit. You're very right.
But Europe's also rallied at the Eurostoxx 50 up at all-time highs. We saw it the FTSE's looking sweet. The DAX was running. I think even, France is just at all-time highs. So there does seem to be a bit of a shift out of a very expensive and perhaps slightly riskier market. And if you want other tech, China's where to go. There ain't no tech really your tech in Europe is what? SAP.
Well, to be fair, right, South African markets are at all-time highs.
Like
right?
almost everything.
Everything is at all-time highs, and this is typically what we see going into Jan, Feb, March anyway, and then we see a bit of a pullback going into April. But the important thing around when we look at, and I'm looking at our wall, right? We're going to see what we update, what we add, and all of that. But I'm looking at the wall, and we have the likes of BlackRock, the S&P, NVIDIA on there. But we also have JD.com, Tencent, BYD, ByteDance. We've been liking Asian stocks because we've felt that they're undervalued. And to look at them now and still say, do we like them even more is, I suppose, the next question is now to say, we've come through a time where they were the unloved child, the black sheep of the family, because of what was happening in China and everything. But time and time again, we've just seen markets come out 3% on the Hang Seng, boosting our own local markets. Last week, what was the share price? Naspers did all-time highs, 52-week highs at $4,600, 4,600 rand a share. So there's clearly some, and that's off of the back of obviously positivity around Tencent and all of that. But Asian markets are coming back into favor, and does that then mean there's some Asian stocks we might want to add to our wall that we want to look at?
Yeah, so I'm just not the expert beyond the few big tech names.
Yeah.
I just don't know what they are. So typically I go with ETFs. Offshore, it's CQQQ, which is the China tech. You can get on the Hong Kong, you can get ETFs on the Hong Kong exchange. You can get A-share China. You got two, a Signia and a Satrix locally listed on the JSE. I've never done it because I get, in all this time that China's been doing poorly, Lex, I suppose we could say. You've got your Tencent in your process, Richemont, commodities. There's a lot on the JSE. I once ran the numbers and it was, close to 50% of JSE stocks. And it's because Richemont is so big, Naspers process, throw the commodity guys in there, are dependent on China. So
the Richemont thing was quite interesting because now we are seeing luxury is coming back into favor. It's Richemont, it's the Kering Group, it's LVMH. Luxury is actually starting to run again. And that was I think that was more of a testament to how resilient Chinese demand can be. We saw Chinese demand softening and we were all concerned, oh no, this is the end for luxury. They're going to have a terrible year. And then out of nowhere, Richemont kicks us off with, 15% revenue gains. It was a mad number that then said to the market, no, it's not that bad.
Here is a fun fact. So China just had vehicle sales year on year early this morning. And previously it had been 10.5. It was down 0.6%. The Chinese consumer is not yet booming, is certainly my sense. And I think vehicle sales help us understand that to a degree. That would have been January vehicle sales, so it wasn't even New Year or anything like that. And maybe there's some nuances we are unaware of. But China's not out of the woods. But let's also be clear, it's not like they are a basket case. Yeah, they're not a basket case.
They're not struggling 5% along.
5% GDP.
They're not struggling along. They're still, China and India have the highest GDP growth rates of Asian countries. And I think, if I'm not mistaken, China is besting India on that at the moment. They are achieving slightly higher growth rates than India. I'll just quickly check the numbers for you. 2023 numbers for GDP in 2023, not 2024. That was India. That was quite a big number, 7.6%. China at the same time would have been 5.2%. So 2023 year, India was stronger, but I think the 2024 stats might be swinging a little better.
India is expected to grow 6.4%.
Okay, that's still a little bit better than China there. Yeah. So either way, so then do we then look at that? Do we then look at the Nifty 50, which is the Indian index? It's not something I have made up. The Nifty is is India's version of the
top
ALSI
40.
or the top 40.
Or the FTSE.
So effectively, do we then start to be more optimistic about Asian markets? And like you said, without understanding them too much, maybe go for indices, go for ETFs.
Yeah, I mean, yes. I mean, in India, yes, I do like the Indian market. I don't know the NDA. They've got a weird code for it. There we go. There's the Satrix one. It's a very weird market. Although it's done moderately well in its period of being alive, from 55 to 79, hit a high of 95. It's come under a bit of pressure. That's the ZAR one, so it's Rand based.
Yeah, so I'm looking at the Nifty 50 is down about 3.5% year to date. So,
but I mean, again, it comes back to the point is, huge economy, good growth happening, good modernization happening across India, and it does. If we throw them and China into emerging market, and we can debate whether they should be. I mean, they're top of the pile by a long way just because of their size.
There we are.
And India's a much more, say what you will about Modi, it's not a command control economy.
Well, he did meet with Elon Musk. He did meet with Donald Trump recently. He met with the presidents of the United States. The Asian story is a growth story, and that will filter through to markets like South Africa. I want to update the wall in light of that. I want to look at locally, there's big moves that we want to be looking at around Amplats. I want to see where we have Amplats on our wall at the moment. We've got PGMs on the wall. We are liking PGMs, but the Amplats conversation is a distinctly different conversation now because that unbundling, we have a bit more color around what's happening in June.
Yeah, so they will be listing and Anglo American has got some 60-odd%, will retain 19.9%. The rest will go to shareholders. They've got to go to London first because there are London shareholders as well as Joburg shareholders because Anglo American is listed in both. The results were a bit of a horror show, no surprise there. PGM prices, we know what that story is. Interestingly, they had 13.7 billion in cash and they've given it all away as dividend, as a parting gift to Anglo American.
Yeah, well,
as a special dividend.
I suppose parting gifts, recouping some money, whatever you want to call it.
Yeah. So they're calling it a de-merger. So 59 Rand special dividend per share.
That's a very handsome dividend right there. That's what you call a special dividend. 59 Rand a share. Wow. So there's a lot that's happening there. Do we now prefer to then look at Amplats on its own? Do we now then look at Anglo American? How do we now look at the PGM space?
So I still worry about Anglo Platinum, if only because your concern is that there are a lot of people who are going to receive a lot of Anglo Platinum shares around June time and might not want to hold those shares.
Fair.
Yeah, they're going to say, I don't want PGMs. I'm holding Anglo because I like the copper, because I like the iron ore. Maybe because I like diamonds. Nah, that person. Nah.
De Beers.
But there are a lot of folks, and we see this from unbundlings, where you suddenly get shares and you're like, do I really want it? I think there's going to be a lot of folks who say no to the Anglo Platinum. So I think we will see more weakness probably through to the end of the year in Anglo Platinum.
The 59 Rand special dividend. You asked the rationale behind that. And as you're saying what you're saying, I'm wondering, are we not propping up the Anglo-American price for another BHP bid?
So the second part of the question is, do we like Anglo-American? Yeah.
Okay.
Yeah. Because so BHP wanted two things to happen. One was get rid of Anglo-American. Done. They want combine or gone as well. I can't remember.
They really just said keep copper. We don't care what you do with anything else. Just make sure you don't sell the copper.
De Beers,
assets.
I don't know who they're going to sell De Beers to. I think they might just birthday gift it to Botswana government. Like happy, how old's Botswana? I don't know. I don't know. What's the Diamond Jubilee?
That's gonna be an interesting conversation. Or do you then take De Beers private? Do you then delist De Beers and give it back to the Oppenheimer family, I suppose, is another option?
Well, Oppenheimer's...
I don't know.
See, I mean, does Richemont take it?
Does Richemont take it? Because you've got a place for it. So it comes back to that thing that we said about Chinese companies coming in and buying South African mining houses or whatever, when they, platinum companies in particular, when they're looking for that resource. Cartier could have very good use for their own diamond supply. But that's another conversation with the lab-grown diamond kind of craze that we're going through at the moment. So do we then see that? Does True Luxury then say we only use natural diamonds as opposed to lab-grown diamonds? And that's a narrative that you can spin out, and that's a consulting fee we'll consult on one of these days. But that's another conversation we'll have, possibly. We might even look into lab-grown versus natural diamonds. That's not for us for today. We are liking Anglo-American. We are going to put it on the wall from an international perspective as well, because of what's happening there. Are we still kind of feeling the same about some of the other stocks? So Richemont and the likes that we've had, we're still very happy with those. I'm wondering how we're feeling about someone like a Telkom that's now back above 30 Rand a share. We initially had a bit of we were neutral about it. Last week, when you were out, Moshima was on the show and she really liked telcos. Along those telcos, she said she liked MTN, she liked Blue Label, she liked Telkom, she liked Vodacom the least. We have Telkom at the moment under our neutral space, and I see they've just gone back up to 30 Rand, I think it's 32 Rand a share. 35 Rand a share. Sorry, the 32 Rand was the recent lows. They'd come off 38 Rand a share. Do we like them around this level because they're saying that they're a better business, they're doing well?
So, I mean, I don't like telcos, but Telkom is also a turnaround, and that turnaround seems to be happening.
It's a good story. Yeah. It's a good story that's being told. Okay, maybe we might move Telkom out from where it's currently sitting. We'll see how we adjust that. Do we have anything new we want to add to the wall before we go?
No, I wanted to add a China, but we were so way ahead of ourselves. We already had China.
We already had China. I mean, we've got Tencent, Alibaba, JD.com, BYD, ByteDance, the owners of TikTok. They're all in the same kind of we really like them space alongside the likes of Nvidia and BlackRock. So we don't like them any less than those guys. And those are the big tech plays anyway, right? So maybe we find an ETF that we can throw on there as one that might be doing really well somewhere, or a semiconductor ETF of sorts.
Yeah.
Speaking of semiconductor size, Taiwan Semiconductor Manufacturers, TSM. Right. TSM is...
So the China Tech ETF is CQQQ as opposed to just QQQ.
Yes.
So also from Investco, etc., etc. And also looking a little interesting on the charts.
It's been moving quite a bit. Hey, it's bounced off of that 30 points level. It's at 47
had
points.
That September jump, as did everybody else.
Yeah.
Yeah, but it's just, I haven't dug very deep into it, but it does just look interesting.
I'm looking at Taiwan Semiconductors at the moment, and the chart looks quite interesting. Look at that.
Yeah.
Look at that. Right. It is kind of a bottom left, top right kind of vibe. It keeps dipping down every now and then to just give people really good, I suppose it's liquidity sweeps here and there, but this could possibly make our list. This could possibly get on, although as I say that, I want to perhaps do a bit more research around this, and perhaps we look into some other strong ETFs that we might like to add onto the list. But we are bullish over the sector. We have got a couple of ones on our preferred wall already. We'll continue to update them. Please send us through some of your thoughts around the wall that we have, around what you think should make our wall. We'd love to get your opinions around that. We're going to update it. We're going to see how it shapes up. I think it's an interesting time to look at this wall in the first quarter of the new year with all the changes that are currently happening. That's why we're not really in a rush to make some major announcements or significant adjustments to the wall. There's so much that's going on. There's so much that's constantly moving around. We don't want to be liking something one week and then not liking it the next week. So we're taking our time with this. We've got the whole year, obviously, to go through and adjust or make some adjustments to the wall. But the adjustments that we have discussed, we are going to make to the wall, and we're going to see how that goes. And we're going to leave the conversation there. We're going to come back to it next week. We're going to come back after the budget speech, and we're going to see what the South African market shapes up to look like. Maybe there's a bit more optimism around that. Maybe the 27 billion rand that we get to bail out some SOEs and some other stuff goes to actually doing something else other than bailing out SOEs. But this is all up in the air, and this is all stuff we're going to have to come back to next week. We've given you 2 unfiltered opinions of the week. Until next time, investing isn't hard. Just try it.